All right. Good morning. Good morning, everybody. It's Friday. TGIF. Hopefully, you guys are going to do something good this weekend. Keep in mind, next week, short week, also got POW Tuesday, and we got some other data next week, too. So, this sideways, choppy, waiting on data, then getting moves, we're not done with it. We're going to see a lot more of it. We're going to, it's the summertime doldrums. It's what it is. We have the opportunity today for a gap close play, and we're going to get into that a little bit because really there's not much else to get into when it's one of these days. It doesn't matter what stocks are gapped up because when we get data, it's going to erase most of it. Other than penny stocks, I will give it to the penny stock crowd. Penny stocks don't care about economic events. We can get unemployment numbers, CPI numbers, whatever. Penny stocks just going to do what penny stocks do. So on that front, sure, there's always something, but let's just take a look at what's going on. Most of the world is waiting on this data. The Russell's taking advantage of it, up more than 0.5%. NASDAQ next to it at 0.5%, S&P below that, and the Dow dragging its feet. Got Europe up slightly, Japan, China. Look far enough down the line, you got Euro Stocks 50 basically flat, and the CAD 40 down more than 0.5%. But I don't get into politics other than how it shapes the markets, and it's interesting to see the moves in the dollar during and after the debate. And that's not politics, that's just looking at a chart and seeing the reaction. We're going to see more of that as we get closer to the election too. Just keep that in mind. So for today, 8:30 is really the big one. We're going to get a couple of Fed speakers later in the day, chipping teeth, but I think that's raindrops in the ocean compared to what we've got up front. Whenever you're not sure about an economic event, just come over to FX Street. You don't need an account to do this. You can just Google FX Street calendar. It'll take you right to this page. Without an account, you can come in and see what's on the docket for the day, and it gives you an impact gauge. Now, this isn't perfect. All it's doing is looking in the past and asking, when we get this report, what does the market usually do? Is it volatile? Does it kind of shrug it off? It's not a perfect barometer, but if you're newer to trading and you don't know what any of these different economic events are, this can kind of get you lined up, and it gives it to you in advance so you can see what's on the docket going forward, which is really helpful for swing traders, especially when they tell me, well, I didn't know it had earnings. I didn't know Powell was going to talk next week. I went long and whatever, and then they get ran over. Trading isn't just about looking at what's on the chart, right? Got to look around. Everything today is PCE. So let's just go ahead and cover this liquidity gap. I've shown this before. If you've heard me go through this spiel, then sorry about that. But the whole approach here is we just keep doing the same thing over and over until it sinks in. Some of us have thicker heads than others. It's called a liquidity gap, and I get it. You don't see a gap, you see a candle. But you're not thinking about the order flow. At 8:30, we're going to get data, and we very likely are going to get a very large candle. That candle is the gap. It's called a liquidity gap. What we're looking for is price to reset. The idea behind this, if you think about the dome and floors and ceilings, this is a dome, a depth of market. Every tick down below us is a floor. Every tick up is a ceiling. If we move really fast and we go through these levels, the ceiling that will suddenly be over our head will be very weak. We're very likely going to retrace that. That'll be the gap. And you won't see no numbers there. There will always be numbers there. But there'll be new numbers. Notice how there's no numbers here in red below us. So if we were to drop really fast, all these new numbers that show up would be very weak numbers. That's the gap. So if we did drop down very fast, we're looking for a gap close to be able to move back up through those ceilings very fast. I say very fast, but as I'm going to show you, it's usually by around 11 o'clock. Same thing if we go to the upside. Notice there's no green numbers here. So if we pop up really fast, we would then see green numbers here, but they would all be new positions. There's this phrase, first in, first out. So if we popped up really fast, all those numbers would be considered weak hands. That'd be the gap. All right, it's kind of what we're thinking about here. There is a precedent to this. Here's a picture from one of the events, CPI, PPI, non-farm payrolls, doesn't matter. It's an 830 print. Couple of key pieces you want to be looking for. Notice there's almost no wick across the top. We got the data and we got the immediate move in one direction. It also closed near the end of that direction's move. Now, I don't care if we go up or if we go down. It's the shape of the candle that really matters here. We closed near the end of the move. And when we opened, we didn't go in the other direction at all. We have almost no wick here. After we made the initial move, kind of built a bit of a base, stabilized, worked our way back, and we got to the gap close around 11 o'clock. Now, one picture, one time, right? Okay, so what? How about another one? So this is an upside move. Almost no wick. Closed near the end of the move. We didn't really digest very much. Just ended the move. Tested the halfback, which finally broke. And we came back down and got the gap closed. Notice how price paused there. Those 3 or 4 candles in a row. I'm on a 5-minute chart here. You can't tell me that price wasn't responding to coming back to this initial move. Look at the way those prices responded there. You know, Adam Grimes wrote a book about trend lines and talked about, well, you could just draw a crap load of trend lines all over your chart. And when price hits it, then you can say, oh, look how price is responding to my line. How about drawing the line in advance and anticipating price going to that line and then responding when it gets to that line? That kind of throws Grimes' argument out the window, because this isn't just putting old random lines anywhere we want. It's having a specific line in a specific location for a specific reason and expecting price to respond when it gets there. We got there a little early, before 11. And this overshoot move, you'll see that quite a bit after we get the gap closed, kind of get this overshot. It's interesting how that happens. And that's like a reciprocation play too, because once we went under it by X amount, we went back above it by X amount. That's not really the focus though. It's the gap close. So here's another one. This one was CPI. We know that because I wrote it this time on the chart. Same thing. Notice from the beginning, almost no wick. Yeah, it's a theme. Now this one paused in the move. It had the first initial push up. There's a little bit of worry about how far back it fell. We want it closing near the tops. We don't want it closing in the middle. We don't want it closing less than the middle. In fact, we want it above the 75% mark. So imagine if we were to measure this candle and mark it at its halfway point and at its 75 point and its 25 point. Those are quad levels or quadrants. We want it in the upper 25%. We don't want it anywhere else. Once it paused there, price had a hard time getting out of it. That became a temporary resistance. So the next candle struggled. The close held even though we tested it. The high held as a resistance. Got the next candle and then the continuation of the move. And again, it didn't close at its high, but it did close greater than 50% and it closed better than 75%. Continued the move for a little bit more, then we digested sideways before we started working our way back to the gap close. We got there before 11 o'clock. Notice how price responded to that line. It's just a random line, right? It's what Grimes would say. I just draw lines on the chart, price will get there. Even broken clocks are right twice a day. Surely it's just that. Yeah, right. It's a coincidence. So this is what we don't want. One of the things I found when it comes to strategies is showing you guys beautiful textbook, perfect examples doesn't do anybody any good. You really want to have a good idea of what we don't want to trade. And I'm picky. I don't care. If it's not a good setup, I will trade something else. And I'm not saying that you can't trade if we don't get a gap close. I'm just saying that if we get a gap close setup, you got a much better trade. So this is what we don't want to see. Price went in a single direction, but it has a big wick down here at the bottom. We don't want that. And after it set the high, it pulled back a long ways. I marked the 50% mark, so we know it didn't close below that, but it certainly closed lower than the 75% mark. Look at the next candle too. It didn't even have the strength to come up and test the previous high up here. It looks like it stalled out just above that 75% mark. It just couldn't keep going. Now, did it close the gap? Yep. But it got that gap closed in less than an hour from the 8:30 to the 9:30 print. This is non-farm payrolls from February 9th. So it's a successful gap close, but I wouldn't have played this. I wouldn't want anything to do with it. That halfback came into play later on when we finally got through it. So did the gap. Again, you can see how price responded to that level. Even after we came back through and washed all of it out, price still responded to that level. So this is what we don't want to see. If it looks like this, I won't play a gap close. I'll just play something else. Another example of what we don't want to see, big wicks on each side, closing near where we opened. This is not what I want to see. If we get this, forget it. Let's just trade something else. It's another example of what we don't want to see. Big wicks, forget it. Do something else. Another example, kind of get the idea, right? This is not what we want. Now, these liquidity gaps do not just have to be at 8:30. Here's an example of multiple liquidity gaps in a single intraday trading session. The market starts in this darker green area. This was Globex in the lighter green area. So 9:30 open. At 10 o'clock, we got news, got a big liquidity gap here. Later in the day, we got news and we got another big liquidity gap here. This gap was closed almost instantly. Within 30 minutes, we got that gap closed. Came back down, dropped with another liquidity gap, got the first gap closed, popped up and got the last gap closed. All of these gaps made on the day and all of them closed on the day. So you can find them anywhere. That's the play that we have on the table today that we could get. Pretty cool, huh? I think so, but I'm a nerd. Spot gamma levels for the SPX. This is their founder's note for the AM edition. I went ahead and just marked them out on the SPX. A lot of places think we're going to pop to the upside today, and there's a lot of options structure and all of that that suggests that the upside is kind of probably where we're going to go. we've been sideways all week. And what happens when you have a sideways market is it starts to build up energy. And the market's like a living thing. In nature, you don't ever let something build up too much energy. You always have a relief valve somewhere. That's why even dams let water out, right? Because if you bottle something up in nature and you don't give it a place to release some of that energy, it'll just explode. The market needs a release. It's been building up more and more and more energy. Now, there's an indicator that came out a few years back called the RSI Laguerre. It's a really odd indicator, and it brought words with it that we don't normally use in trading. Usually, we say momentum, trend, inertia, words like that. We don't talk about energy. This indicator is pretty cool. It showed us how markets are building up energy or where they build up energy. And when we see markets consolidate, when we used to say it's pausing, it's catching its breath, it's digesting, that indicator would show that it was building energy, like recharging your batteries or putting gas in the car. And when a market makes a move, it can make a move spending energy that it's built up, or it can make a move and it can actually build up more energy in the move. Kind of like when you wind up a toy, you're building energy up because you are moving something. The analogy I like to use is if you go out in the yard with your kids and you throw a ball, as the ball travels, it's losing energy because you put energy behind it and threw it. But it's going to lose energy as it moves and it's going to run out of energy. Take a ball to the top of a very big building and drop it off. As it falls, it's going to accelerate. It's going to build up more energy. It's gaining energy in the move. So again, back to nature, markets just like nature. When a market does make a move, we want to be able to answer that question. Is this moving with energy behind it? Is it being propelled and is slowly losing energy? Or is this move building up energy as it goes? Interestingly enough, the RSI Laguerre shows that. But the whole point of talking about the Laguerre is that when we go sideways like this, what we learned from that is these sideways markets are building up energy. Now, before the Laguerre, we would just use things like TTM squeeze and things like that, which also shows compression, shows volatility winding up. And so we had the expectations of markets coming out of a squeeze with a big move. Cool. So it's not like it's some revolutionary thing that we were blind to before. We've been range bound. The market doesn't like being range bound. The longer it's range bound, the more energy it builds up. When the break finally comes, it's usually a fantastic move. 2 to 3 standard deviations of the regular move. Now, I get it. Not everybody's into math. I start talking about bell curve statistics and dot plots and least squared methods, and your eyes kind of glaze over and you start drooling. This is the analyze page on Thinkorswim. The gray area here is 1 standard deviation. We know that because it says it up at the top, little drop down, 1, 2, or 3 standard deviation. Set it to a 1 standard deviation, it's 70%. There's a 70% chance that the market will stay inside of this gray zone between now and the 4th. Well, the 4th is kind of a long ways off. So let's just tighten that up a little bit to something a little closer. For today, set our curve with our break-even lines. 55.47 to the downside, 55.19 to the upside. Now, this is for the SPX, and that isn't open yet. And we already know that the ES has drifted up, so the SPX won't open where it closed yesterday at 54.82. So instead of the SPX, let's try the SPY because it's still moving. There's your 1 standard deviation move for the day. 552, just round up 2 pennies to the upside, and let's call it 544.5 to the downside. Well, that's not bad, right? 6-7 point move, 1 standard deviation, 70% chance we close in that zone. I would say this isn't going to be good enough on a day like this, where we're talking about a 2 to 3 standard deviation move. This is a 1 standard deviation. So how much bigger could it get? This is the point I'm trying to make. You see how much bigger it just got? That's a 2 standard deviation move. It's a 95% chance we close inside of this range. You love probabilities and statistics, right? How about a 3 standard deviation move? That is a 3 standard deviation move. 550.5 to the upside, 537.5 to the downside. For SPY, you're talking about a 30-point move in SPY. There's a 99% chance that we'll close inside of this box by the end of the day. Markets can go much farther than a 3 standard deviation move. During COVID, we've seen 7 standard deviation moves. Imagine. We're not expecting something that big today, right? Even the initial move from CPI is not expected to breach the 1 standard deviation. I'm not proposing that the data we're going to get at 8:30 is going to move us this far. I'm proposing that after we get the data and we get into the regular trading session, that we could then start to expand and get a run day for a number of reasons. It's the end of the month. It's the end of the quarter. It's the second half of the year starting next week. So we've got all these flows that are going to be coming in because of that. And we've got data coming in, and we've been bottled up sideways. We also had that move in the dollar last night, which can unwind really fast. We've also got this disconnect between the S&P, the NASDAQ, and the Mag 7 right now. Typically, the NASDAQ leads. And sure, if you look at the prices, the NASDAQ's up 0.43% this morning. S&P's up 0.33. So the NASDAQ is up more. But on that initial move, and I just marked one spot. And if you look at all the screens, when I just stop my mouse there, the mouse shows up on all the charts. It's where the 10-year started to fade, the NASDAQ started to fade, the S&P faded, the dollar popped, US dollar Japan popped. So mark that level, send it across. The S&P is back across that level. NASDAQ's not. Dollar broke down, US dollar Japan broke down. So the move was unwound in these different places, and even unwound in the ES because its move was a pullback. So it unwound that to the upside. NASDAQ didn't unwind it. We got this disconnect. We've had this sloppy, nasty NASDAQ while we've had the Mag 7 ripping. Yeah, I'm telling you, there's just a lot of reasons to believe that today could move after we get the data. So you've got the 1 standard deviation, 2 standard deviation concept. Start with the ADR lines. We're really close to the upper ADR, riding above VWAP, really nice. That won't matter when we get the data print Neither will the ADR line. Without the ADR, the base case, since we're already this close, is that we would just go ahead and tag that ADR line. But because we have data, we want to focus on this market maker move up here. Now, if you're on a broker that doesn't have that, go to the options chain and see if they have an average implied volatility, because you can still see a market maker move as long as you have that data. We had our range set for the week with Monday's high and Monday's low, and we've been riding inside of it all week. We're outside of that range. So we've broke out on the week from our own price movement. We're still inside last week's range, however. We can see back here, 55.90, 92 is a cog line. 55.11 to the downside is a cog line. So we've got one on each side of us. That's the range that we need to get out of if we're going to really expand today. Up or down, doesn't matter. When it comes to this market maker move, by the way, the average thing that the market does is go between these two red lines. It's what it has been doing over the last 21 days. Sometimes it'll move the entire ADR in a single direction from the open or close, and that would get us all the way to the yellow line. What if we go even farther than that? Well, that's where the market maker move comes in. We would add another 22 points. So from 55.98, call it 56.20. And from down here, 54.98, call it 54.75. It's all the way down here. That's the range that we have for the day, or those standard deviation levels, either one. Now we can look at pivots, but the pivots won't matter when we get data. A couple of things that we can identify, though, is today's channel is higher than the previous day's channel. It's completely outside the range. And if we're looking at this, let's focus on that one. Yesterday's range was that very, very narrow channel, very skinny. Today's is above that or outside of that. Let's just push this chart back so that other one disappears. There. So we're above it. That's considered bullish. We're above the R1. That's also considered bullish, but above the R1 isn't a big enough gap. If we were above the R2, then we would say that's such a big gap, it's probably going to stick and we'll continue to gap even farther away. That'd be like a gap and go. But an R1 gap isn't a big enough gap. If we can close above it, we could magnetize around it. But what happens more often than not is if we're around an R level, say like right here, as we get into the open, then we'll go back and we'll hit that pivot point. Markets hit this pivot 80% of the time. So if we're not above the R2 or below the S2, very likely we're going to do what we do 80% of the time. We're going to touch that pivot. All those stats kind of get muddy, though, when we have data, and we have data today. 8:30, we're going to get the data. Everything's going to shake loose. And then we can go and look and see what's gapped up, what's moving, what sector is it, what industry is it? Is it the Mag 7 and big tech and those kind of names, or is it utilities, industrials, healthcare, staples, those kind of names, growth versus value stuff? Oh, very nice. I guess TradingView got an update. That's cool. That's not what I wanted, but that's cool. I just wanted one of my own charts. So cool. You can search for your own charts. IWF, IWD, growth versus value. It's a nice ratio chart. You can see the moving averages in a beautiful fan. They're all pointed with a nice angle to the upside. They're spread apart, textbook perfect. We've been tagging in the new highs on this. If we overlay something like the SPX on this, you can see that when growth versus value ratio is moving to the upside, so is the S&P, right? Is that perfect? No, but it gives you a pretty good idea of why we're watching this. All right. So if growth versus value was going down, we would expect the S&P to also go down. Same with the NASDAQ, right? That sort of thing. So simple concept. Not a roadmap for day trading, right? You don't want to go in and look at this as a reason to go long or short in a day trade. Just what's the broader market doing? This ratio moves in the pre-market. So as we get closer to the open, say 9 o'clock, even 9:15, you can go in and see what this ratio looks like and see if it's gapped up or gapped down. That'll give you a good idea about that growth versus value. Cool, cool. Wait for the data and see if we get the gap close play. Watch the clock. Everybody be careful, be safe. Have a good weekend. I'll see y'all next week.